So I wanted to do a quick kind of chart analysis of a trade that one could have taken. I didn't take because during this period of time I was still focused on scalping, and I hadn't yet made the transition or attempt to try to become more of a swing trader or position trader. Um, as I've been reading uh, the books by Mark Minervini and studying people like Chris Kulamagi, and trying to adapt their style, I had been clicking through and I've noticed this chart of alpha omega semiconductors several times. So it looked really clean, like the setup looked great. And if you'll notice, it looks really similar to the move in the oil sector in the last month or so. Names like XOP, EOG, well, XOP is the ETF that tracks some of those names, but PXD. If you'll look at the date 12/29 and follow that back for a few weeks, it looks very similar to this action that's happening right in here. So basically, I wanted to real quick just go over kind of entry and exit and kind of position management. Now you noticed initially, one could say like, oh well, wouldn't it have been great to buy like way down here at $10 or less? But the answer to that is actually no, especially if you study or believe in the work of Mark Minervini, which I'd imagine you should because he has won the U.S. Investing Championship multiple times. He's an excellent trader. And he would say that this area, you're you're tying up your capital too long. Like the time value of money is important. If you're buying down here somewhere in this big long base, this several year base here, your money is just sitting there moving sideways, and there's tons of other opportunities that are moving up with velocity, and your money's just tied up moving sideways. That's fine for an investor, but if you're looking to be a trader, it's not okay. It's kind of unacceptable because you're tying up capital where there's no trade to really be had, no trade to be made. So from his book, he looks at things when they're sometimes 100, 200, or even 300% over where this base comes in. And once they're up there, as you can see this run here, from this base that bounces between 10 and about, 10 and about 15, it goes up to 40, So we're talking that approximately that 300% range of it lifted off and it had some serious interest. Now, during this period of time, you'll note that this is all kind of during that COVID. This right here is actually the drop from the initial COVID shock right here. And when the supply chain issues became a thing and the chip shortage specifically hit markets really hard, this is in that sector. This was a strong sector, a leading group, and that kind of propelled this up out of its base. Now, looking for a proper entry is when things get a little more technical. Now, you can see, if I kind of bring this in a little here, you can see I've made some lines here. These are just to help focus on the kind of the trajectory of what's going on here. Don't read into the trend lines that I have there. They're not really important. They're just to help visualize the movement. Now, I've drawn these three circles. These circles are areas where I personally would enter. I believe that's what Minervini would refer to as a low cheat entry. From what I've picked up so far, I'm not too far into his book, so I could be wrong on that, but I believe I've heard him refer to this as a low cheat. Now, as a scalper, that's kind of how I trade. So it makes more sense to me to buy in those areas as opposed to where Minervini would be buying, which is more likely to have him buying in this range where I've drawn this price level here. Because what he wants is for it to be moving up, which, of course, that's kind of what I want too, but I try to fight for a cheaper price. But he wants this to be moving up and buy it when the wind is in his sails, the wind's at his back, so to speak. And he can just ride this quick movement up and sell into strength at certain risk multiples, selling portions of the position. I've heard some traders, an excellent trader that's been interviewed on the Trader Line channel several times named Pat Walker, believes that he would sell approximately 20-25% into this strength and then let certain portions run. I believe Minervini is more of the opinion that once you hit your profit target or a certain risk multiple, you would sell half the position. Now, psychologically, the reason half is good is because, well, you locked in a good portion of profit. So if it reverses and it hits your stop loss, which at this point, if you're selling up in this range, you should be trailing that stop up, and it shouldn't be down here where your original stop would be. So you're taking a bigger profit on half your position and potentially a smaller profit on the remaining half. But what it also does is if you get the rest of this move, well, you still have half your skin in the game. You still have half that capital deployed in there to capture other parts of this move. Now, note, this is a weekly chart, not a daily chart. So every one of these bars represents an entire week. It's my preference to search for opportunities mostly on the weekly chart, somewhat on the daily chart, which is hard for me to do. And like I said before, I'm used to scalping, so I'm trading on like 1 and 5 minute charts. However, as I've been studying Chris Kulamagi, or Kulamagi, I think it's Kulamagi is how you pronounce it, the Swedish trader, I've heard him mention a few times that he wishes he could trade less and he wishes he would trade more off the weekly chart. So as I'm adapting to his style, his methods, to a large degree anyways, I figured why not start by kind of forcing something on myself that he wishes he would do. So that being said, I will look at the daily and the monthly chart here in a moment, but I just wanted to get some baseline information out there. So why is this area of particular interest? Well, what you'll notice here is we have a lot of these moving averages starting to come in on each other. Let's look at right in here. Let's bring this back even a bit. So you can see very clearly on my charts, the red, white, and blue moving averages are 200-day, 150-day, and 100-day respectively. The orange is the 50-day. Now, you'll also notice that there's a solid line and a dashed line of each color. The solid line is the simple moving average. The dotted line, or rather like hashed line, if you will, is the exponential moving average. Now, an exponential moving average is weighted towards more recent action, but full disclosure, I don't know how that weighting works mathematically. I just know people use it, and if a lot of people use an indicator, it's more likely to work. So I put them both on there because I know people who use one or the other, so I said, why not use both? Yeah, it can kind of look kind of cluttered here and there. But regardless, I use them both. So the reason this area is so interesting is because we stop getting these large, emotional, volatile moves, and the ATR, the average true range of the stock, starts to constrict. And that's really what you want to see. And that's one of the biggest things I've picked up from Mark Minervini is the volatility contraction pattern, where you start to see things tighten up as they either move sideways or drift slightly lower. They don't have to be drifting upward. They're forming a kind of a secondary base or a cup kind of formation on the chart. And then what you want to do is buy at a particular point at which you believe it's about to move into its next step up. And that step is a reference to Darvis, who wrote a book that I can't remember the title of right now. Oh, How I Made $2 Million in Stocks. And this was, I want to say it was in like the 40s or 50s or something like that. But inflation adjusted, it was how I made 50 million-ish in stocks. But the title of the book is How I Made 2 Million, which at that point in time once again, inflation adjusted, 2 million was a ton of money. And what Darvis noted is that stocks tend to move in stair steps. So what you'll see is kind of this area. So you have this kind of outsized candle in regard to recent action through here, through these weeks. And then you have several tight candles right in here. Well, then you have this up one. Oh God, what did I just do? All I did was click once and it threw my chart way off. All right, we're back. So you have this up one right here, and then you have a drift lower. And hopefully this is going to start to get kind of cluttered, but hopefully it works. Why is my square not working? And you can kind of picture these like steps. And he noted that pretty much all stocks move like this. And what you want to do, what he wanted to do, was buy a stock right as it moved into its next step and then hold it for several steps as it goes upward. Now, it's kind of counterintuitive in regards to what a lot of people would think, and that's one of my biggest struggles as I'm trying to become a swing trader. Is as a scalper, I'm always fighting for cents. I want the best entry. I want to enter just a hair below the VWAP if I think it's going to bounce off the VWAP, So it's a struggle to try to buy to like the way Darvis approaches. He would literally say, I don't want to buy this stock unless it hits a higher price. Whereas most people would think, I want to buy it now and buy it down here and potentially sell it or take profit as it hits that higher step. But the fact of the matter is that shows a better understanding of supply and demand. And especially when you line that up with the volume bars down here, and you see this fluorescent green shows like an outsized amount of buying volume or high relative volume, I should say. It's not necessarily buying, because as you can see, this green is on a red candle. And this green is on a green candle, a huge green candle. But what you'll notice a lot of times, what I like to look for is a move up and then several inside weeks, days, or even months potentially. In this case, once again, this is the weekly chart. So what do we have here? We have a large move upward. Now we undercut our 50 EMA for a couple weeks here on the weekly. Now on the daily, this will look different because these moving averages are based on the bars, not the actual day. So when I say 50 moving average on the weekly, it means 50 weeks. On the daily, it means 50 days. So they're going to be at different positions based on the time frame of the chart. But that being said, we're drifting under the 50 weekly, and that's actually kind of a positive thing in some regards. The reason being, a lot of people use the 50 moving average. So that will knock some of the weaker holders out. Maybe there are people that bought in down over here or even up here, and they finally have given up. But other people, as you can see, it dips. This candle opened here this day. It got as low as this, and then it got bought back up. Actually, no, I said that wrong. It opened here, dipped, and got bought back up. And then we have kind of a hammer candle here. It opens here, dips, gets bought back up. So that is bullish action because people are buying it below this level. And what you can see is then it drifts really closely to the 50. Now, what I like to see once again is this right here specifically. It goes up, it rebounds, bounces off of its 50 weekly moving average. Then it has several tight weeks right in here. These are beautiful. They're slightly descending, very constricted ATR. So you know the supply and demand, the buying and the selling is getting very equalized. And then what do we have? This next week, boom, another big move up into that next stair. Personally, what I would do, and as you can see, this red line is here, I usually give it 3 or 4 days. So sometimes I find myself entering a bit too early and then potentially even stopping out on some small paper cuts in these positions through here, but jumping back in, and then your initial gain if you're pyramiding, is going to be much greater than those little paper cut losses. However, what I would recommend, you can see I have this red line here. I'm going to go ahead and remove all the studies. So all the moving averages and all this other stuff gets off the screen outside of the drawings that I've made. Because I have that study set saved, so it doesn't take too long for me to add it. So looking at just this raw chart right here without all that clutter, what you can see this red line I have here, that would be where I'd approximately set my stop loss, right? So let's even put it at the bottom of this candle. And then you have these tight weeks. Let's say you entered somewhere in this oval that I have drawn here. I'll get rid of these, remove drawing. And this would be a cheat entry that I wouldn't actually recommend. This would be my preferential entry. Once again, as I believe I mentioned before, this is where I believe Mark Minervini and other championship traders would enter, because they are hyper concerned, as it's a competition. They're hyper concerned with the time value of money, whereas I am concerned with it, but I like to get a bigger percentage and fight for that little bit cheaper price, as opposed to being quite as concerned or weighted towards the time value of the money. That being said, this collection of tight weeks in here is a fair entry point. The reason I say that is because you can have a logical level to risk off of. Now, with all these being a week, you have 5 days of trading, 10 days of trading, 15 days of trading, 20, 25 days of trading. Now, let's say you entered here on one of these candles, or even here. You could logically set your stop, and that's what it's all about, is having a place where you can logically say, if it breaks here, I know I'm wrong, and for now I need to get out and let it set up. Now, you have these 2 weeks that are very tight inside candles. You can set your stop at the bottom of the low of that week, so you know if it hits there and it doesn't start getting bought up, you're wrong. You can get out. Now, that being said, let's say you entered here with your stop here. Your entry, let's even assume you didn't catch the bottom of this week or the very bottom of this week, and you entered right in here. We'll call it 26. We'll call it 26 even. Now your risk then is 23.72 or even 23.70, let's say. Now, you need to size your position for your risk, how far away your risk is. It's not necessarily a bad thing to enter here, but you don't buy your full position. In theory, let's say you want to buy 100 shares, but you don't want to risk losing, what is that? That's like $200 something. We'll call it $250 just because I don't want to do the math. You don't want to risk losing $250. You only want to risk, let's say, $75. Well, then you need to size your position such that if you buy at 26 and you get stopped out, your loss is $75 because that's what you planned for. Not all of your buys are going to work. It's a game of probabilities. So your stop loss is going to get hit from time to time. No one has 100% accuracy. Most people, and when I say most, I mean like 99% of people, don't even have 75% accuracy. Very few have 60% accuracy. A lot of great traders have between 30 and 40% accuracy. I'm talking like the aforementioned Chris Kulamagi, the Swedish trader. I believe he's stated several times that he usually has about 30 to 35% accuracy. But the fact of the matter is it's a probabilities game. If you're taking a 1% loss on your average stop loss, but you're taking at least a 3% gain, hopefully more than that, well, then you can afford to cover 3 losses for every 1 win. So that's how it becomes more of a probability game. And if you're really good at finding these setups in the strong sectors, and let's say your risk multiple is actually more like 5 to 1 or 10 to 1, you can afford a handful of losses before you have any winners, and those winners gain you so much more than the losses took that you're profitable. So it's not about being profitable in every single trade. It's about having your winners outweigh your losers to a degree that you're profitable. So back to the trade here. What I would personally love to do is enter here somewhere on one of these weeks, because once again, very tight volatility here. Very tight volatility here. The volume looks decent, not huge yet, which once again, the championship traders would like to see a kind of a lift off in the volume, above average volume, before they entered. And that's to really make sure that other people are seeing what you're seeing, and you're going to be able to get in and sell partial or all your position quickly, in and out, onto the next opportunity. But I would love this entry right here. Once again, I feel like I've said once again a lot. I probably have. But regardless, you have these few tight weeks, and then you have this low. Now, let's even say you didn't quite, because I think it's best to think of a lot of this stuff as a zone too. You can have a hard stop, and you should have a hard stop, but some things should be more of a zone. You got to let your trade breathe. You got to let it work. So let's say you got in, somewhere in this range, right in here in this oval, and your risk percentage, you got in on the day or so after that it made this range here, and you set it at the bottom of the week after this tight week right in here. Let's even say you bought as it reclaimed the lows of this week. The first couple days of this week, as you can see, this week opened here. It got as low as here, and it ended here with a high of here. If you know how to read a candle, it's very, very easy. So let's say you bought as it reclaimed these lows. Oop, I thought I had the price level tool. Let's say you bought as it reclaimed those lows. Ooh, I don't like that scale. That's better. You bought as it reclaimed these lows. Your stop out is the low of the week, which is just over $27. Your entry is approximately 27, let's even call it the high side of it, 27.90. Your stop out, it will be, we'll call it 27 even. That's giving you extra wiggle room on each side. So we won't build a straw man kind of case here. So let's say your entry is right in here. Your risk is 90 cents. You're willing to risk $100 on the trade. You can easily buy 100 shares, and if it hit your stop, in fact, you wouldn't even lose $100. You'd lose $90 because once again, 100 shares, if it hits your stop loss, that's about 90 cents away. That'd be $90. $1 per share. Every cent is $1 when you have 100 shares. So you buy here, and now your risk being 90 cents, that would be, for this trade, 1R. 1R is equal to 90 cents, which generally speaking should probably be based on a percentage of your portfolio too. As far as your position size, if that's your stop. So let's say it hits 3R. And in this case, it had very bullish action, so I probably wouldn't have sold any just yet. But now it comes into this week where you're at a point where you have made you've made 10 times your risk or so at this point. Well, then maybe take a portion off. Like I mentioned, Pat Walker would take about 20% of the position off. And then move your stop loss up to where you're profitable, no matter what. I'd say potentially maybe these highs. You don't want to move it up so much that the stock breathing is going to knock you out of the position. But you do want to move it up so that even if it does have something crazy happen, you get stopped out for a small profit. So into this very bullish strength, And as you can see, this week opened here and even had some bullish action and then got sold. Somewhere in this range, when you've hit several multiples of your risk, maybe take a percentage off. Maybe take half off. But what I'd almost recommend is what they call pyramiding. So at this point, for me personally, I'm usually trading several hundred shares, maybe even 1,000 shares. So what I would do, once again, I don't recommend this entry because it's just too sketchy for me. I want to see it start to form higher lows and higher highs as it's moving. So we have, this is kind of a huge wick here, so that's kind of like hard to read. But it's forming higher lows, and that's what you want to see. So I'd enter up here after we have several higher lows, and then I would have bought, let's say in theory I wanted to get up to 500 shares. I would have bought maybe 200 shares in this range, and then in this range where you have these several weeks that are fairly tight, once again, let's say I buy another 200 shares here, and then in the Minervini spot where you're showing very bullish action, and you start to see the volume down here really pick up, polish off that last 100 shares. You know, if you want to get up to 500, 200, 200, 100 in here, and then since you've pyramided into the position, after these huge volume, outsized, very euphoric kind of candles, these big candles, at this point, personally, I'd sell half because I love how Minervini thinks about it. Now, some people would say that this would not be somewhere you'd want to sell half simply because then you're breaking out of this cup finally. However, I would sell half right here. And I would set my stop probably at the low of this week. And then as we progressed, or depending on the daily chart, I might even set my stop higher. And then as this goes up, I would be selling into these strong candles. There's a good shot that I would be out before any of this up here. So if I go back to the square tool, there's a high probability that I would never be in a position in this area because I don't have a crystal ball. You know, I can't see the future. So there's no way I know that it's going to get that good of a move because we're living in this area in the present, you know? So when you see something move that many times your initial risk, it's good to just take profit and look for the next similar opportunity. Once again, you're playing a probability game, not a luck-based game. This isn't a casino. It's a probability game. And you're taking in quantitative data to make a risk, to take a risk and hopefully become profitable. So you need to be having some solid sell rules to be able to take those profits, and you're never going to get the absolute bottom down over here. You're never going to get the absolute top. Anyone who says that they do that either did it on like one lucky trade out of thousands of trades, or they're liars. Either way, probably, it's very, very rare and probably not true. But back to the actual trade, let's look at this on the daily time frame. Now, I do look at the daily time frame a lot, and what you'll notice is this right here that I mentioned earlier looks a lot like a lot of names in the oil sector looked recently. And I did play several of those, and they were like my first true swing trades and my most profitable. I do believe that swing trading is significantly better than scalping overall. It's less work for a more percentage move, and the largest errors that I had in my trading personally were based on execution. So they were based on the decisions I was making. So just inherently, if you're swing trading and you're making less decisions, you're giving yourself less room for error. And that is the way to go. That's the name of the game. Less errors, more profits. But once again, you can see this on the daily chart. You start to form these higher lows as these weeks progress, and enter somewhere in here. And as you're getting these moves, and let's say you fully pyramided in right in here, you're 500 shares long. Well, then maybe it has this nice bullish gap up. Let's say you move you let this flag and this kind of handle here start to form. Well, once it's moved into this area, move your stop to the bottom of this candle. And once again, I had said earlier, I would have been selling half in this area, definitely. Just the way I trade personally, I like to take some money off the table and start looking for other opportunities, and then let that other half run. Well, then move your stop up to this line, and then let's say on this next bullish move up, move your stop up to in here, and then eventually the capitulation is gonna come in, and the average true range of the stock is gonna expand because people are getting less sure about if it's worth this value way up here. And eventually, as you're moving your stop up, you're either going to A, get bored of the position moving sideways and just take the money, or B, it's going to, one of these big candles, like let's say you had this day and you move your stop loss up to here, one of these days you would have got stopped out, but it still would have been for a great profit from your initial risk down here. So yeah, that's the name of the game. This actually went about twice as long as I thought it was going to go. I will probably do a few other ones. Maybe I'll make some of the oil sector that I mentioned. Oh, I said I was also going to look at this on the monthly time frame. 5 year, 1 month, just for good measure. So here it is on the monthly. You have all these months of trading. Every bar is an entire month. So there's not noise on this chart. There's not that extra emotion. And then you have it lift out of the base, several 100%, and then it forms this cup. And if you're buying in, pyramiding in during this, the right side of the cup, the part where it's forming higher lows, if you're pyramiding in that region, boom, you get these big emotional moves, and you're selling into that strength. And that's the way to do it. And that's all I got for now.